Good afternoon, everybody. Welcome to TraderMerlin Show for your Wednesday edition. For many people, a shocking kind of result for the day. We had some really great CPI or PPI numbers, and all of a sudden, markets just responded negatively from the onset and almost all the way through to the very close. So we'll look at that, and I guess the big question of the day, which I received 3 different comments on, by the way. Thank you those who sent in questions at TraderMerlin@gmail.com. Lee gets the screen time, though, because he says, I don't get it. Why do the markets tank on good news? Which leads me to the topic du jour, which is, why did markets tank with great inflation numbers today? So let me start there, and then we'll dive into what happened to markets and give the overall, I guess, landscape where we're at. Before I dive into kind of why these markets tanked today, I'm curious to see why you guys think the markets tanked. So let me real quickly show you or read to you the number, because I don't want to give everything away here yet. Core CPI or core PPI was 0.2%, came out at 0.1%. Okay, no big deal. The PPI number itself, which is Producer Price Index, which is what it costs manufacturers to make a basket of goods and services, that went from 0.2%, they thought it was going to be -1, came out at -0.5, which means we've seen almost a 0.5% decline in the prices of goods and services month over month, which is a huge drop compared to expectations. This, of course, is something that the Fed has been raising rates aggressively to accomplish, right? They're trying to drop those prices. But why? Why specifically do we get a chart that looks like this? Right? I mean, obviously, you could argue you came right up to that trend line and kissed it and sold off from there. That might be one piece of it, but that by itself usually isn't a massive catalyst. And I'll show you the intraday here on the S&P. You know, it was a bloodbath all day. Right as announcements happened, it was a bloodbath from that moment on. So I'm reading through here. Randall's, my head's in Mississippi. Well, you better pull it out of there before you get hurt. Chris says the 200 period moving average and technical. Nope, not that. Many tech layoffs. No, not necessarily that, because the market is very disconnected from companies behind the ticker symbol. I mean, you could argue that they're a little bit disconnected. Ivan says already priced in. I'm going to say a little bit of that. It really goes back to another piece of economic data. Remember, we've talked about this battle of, let me rewind. I've talked about how the Fed has backed themselves into a corner, right? Because the dirty word was stagflation. Stagflation means you've got GDP declining, you've got unemployment surging, and you have really high inflation. Well, we have 2 of those numbers, right? We have GDP declining, although it's changed here recently. We have really high inflation, but unemployment really has not been an issue at all. So you can't argue stagflation. The big problem is when the Fed does one action, it generally impacts something else, right? It's kind of like in your life, if you're in a boat and you have all this weight on the right side and you take the weight off the right side, well, all of a sudden it's going to start to shift over towards that one way or the other based off what you've moved. Nope, not Fed speakers. The dollar was a result of this. So when we talk about the impacts on inflation and the actions the Fed can do to impact inflation, number 1, raising rates aggressively. Okay, they've done that. Check. Number 2 is removing money from the money supply, meaning remove dollars from circulation. Check. They've been doing that, right? They've been selling bonds every month. I think it's $90+ billion a month, taking those dollars, removing them from supply. That means less dollars chasing the same amount of goods and services. Therefore, prices should be impacted. Those are 2 variables. The third one that the Fed can do to impact inflation is increase the reserve requirement for banks. Essentially, prevent banks from or slow down banks lending out to people. And that lending out process means more money in the economy and so on and so on and so on. So those 3 factors, you're arguing, okay, well, we're doing 2 of those. They haven't messed with their reserve requirements yet. So what's happening? Well, the interest rate piece is obviously creating a situation where the cost of capital is more expensive. It's also creating a situation where businesses are starting to feel the pinch, right? They have debt, and of course, with debt rising, well, that might be slowing them down. But the main reason, I think, is consumption. We talk about the U.S. being a consumption-driven economy. Well, that's a major driver. And while all eyes, including mine, were focused on that CPI number today, and it kind of did what I thought it would do, I didn't think it would be that good. I thought we'd actually come out -0.1 to -0.2. There's another number on your screen here, and I will Of course, probably advance the slides with my stupid pen here. He always does it. Every time I try to do this for you guys, it always screws it up. Okay, so here is, I will underline the PPI numbers, which were just incredible. I actually thought this would come out at negative 0.2, so way better than I expected. Of course, that's something the Fed is obviously feeling positive about. But look directly below that. The previous number for retail sales was negative 0.1. Right? And that's reflecting November's numbers. That's Black Friday, all the crazy holiday shopping. We saw a contraction. We should really see that look better, shouldn't we? Going into Thanksgiving. So the expectations for the December month were negative 0.8. And you got to ask yourself, why on earth would retail sales be so bad in December? This is when we are like, we've saved all the time. Let's spend, spend, spend. And lo and behold, you see retail sales at one of the busiest times of the year getting even worse. This is why we saw this market reaction. Yes, inflation's under control, but what that retail sales number is telling you is that businesses are going to start laying off more and more and more. If they're not selling their products, it's going to pile up on shelves. People aren't going into the stores. They don't need as many employees. So, we talked about a lot of the layoffs going on at certainly all the .com companies and all the crypto companies. But now Microsoft making an announcement today. There's a lot of companies out there. We talked about Goldman Sachs doing layoffs. This might start to fuel even more layoffs. So Jerome Powell, when he talked at the Jackson Hole Symposium, was saying, expect more pain. There's been a long lag time. That's been several months since he did the Jackson Hole Symposium. But his point was, you're going to see unemployment rise because the actions the Fed is doing typically will create a situation where we're fixing inflation, but we're going to hurt economic growth. So now you can expect GDP numbers to decline significantly. Right now, we're going to see inflation decline, but we'll also see GDP start to drop sharply. Now, the magnitude of that decline of GDP and of retail sales and of consumption is really what, in my mind, will dictate whether we go to full-blown recession or depression going forward. So, wondering what it is, yeah, we had great news, but people have felt, and we've talked about it here as a group, I think everyone's kind of said, it seems like inflation is not accelerating, it's slowing down and coming down a little bit. Well, the charts here, let me bring up the chart for you guys. Go to Forex Factory. We'll go and click on, that's for tomorrow. Let's go to our CPI numbers, or PPI numbers, just so we can see what that looks like. Right, we've had a dip down below before. And you can see the numbers I'm looking at here are for PPI. The most recent reading came out negative 0.5, which we also had a negative 0.5 reading back in August of 2022. Now, what will be noteworthy is, do we continue to see below zero, right? If this inflation is in fact under control, then you're going to get next month the core PCE number. That'll probably be lower. And then we start all over again with CPI and PPI, right? Do these numbers continue to drop? If they do, then what you're probably going to start to see even more is these numbers dropping. Here's retail sales. Right now, it looks really skewed because of what happened back here in 2020. So let me zoom into the most relevant stuff and go back just until mid 2021. The trend is starting to become rather clear here. Back in November, and remember when I mouse over here on November, that's reflecting October's PPI number. So it's 1 month lagging. So in November, we had a nice increase in PPI, but all of a sudden, it's been dropping and dropping. Now we'll see if this continues, and if it does, I think these markets may be headed for a south side move and more downside. And conveniently, it just happened so on the daily chart, smacking its head right into that overhead supply. So it was kind of surprising for me. I was actually really thinking there'd be more emphasis on the PPI data, because what should happen there is now we can look at the Fed funds futures, which I did not get a chance to look at today. The probability will start to shift, that there's going to be a pivot by the Fed, and we'll start to see maybe tail end of this year, maybe they start cutting rates if, in fact, we see retail sales numbers get so bad. I was expecting the retail sales numbers to be down, but my short positions on Beth Baby on target did not go down as much as I expected, because I think they got beaten up over the past few weeks from bad retail sales numbers. Let's go to the economic calendar, to our Fed funds futures. So did we get a change, really? More of an increase probability that we're going to get 95% chance of a 25 basis point increase on the February 1st meeting. So no real changes there. Did this change the hypothesis for March, though? And that will tell us it actually did. It looks like there's much more of an inclination towards 25 basis points, meaning, right now we are at, you can see at the top, 450. They're now expecting a 25 basis point increase for February 1st. This means that we may not see an increase, a 25% chance of no raise in March. So the balance of tide here is kind of shifting. It's moving a little bit more towards the market expecting the Fed to pivot, because if they don't slow down their rate increases, what's going to happen? Right? If they keep accelerating, doing 50s or 25s for the remainder of this year, as Elon Musk pointed out, it's going to crush the economy. And some would argue that it already has. I don't think that it's crushed the economy. I still think there's a big lag time, and we still have to wait a few months, probably another 6 months or so, for all these rate increases to actually filter through to the bottom line, which is why it made me so, suspect yesterday when we talked about Goldman Sachs and looking at their earnings, right? The forecasts for banks are 100% gains in their earnings in the next quarter. I really find that one hard to believe. And again, I might find some good opportunities for the short side here on some of these financial companies. But that's in a short 12-minute piece is why we are seeing the bad news. This is why the market's tanked. It's really saying, okay, inflation was great, but retail sales, which means spending, is a very broad measure of consumption. And if that starts to slow down, it becomes this downward spiral. And the downward spiral is businesses slow down, earnings are poor, they start to do layoffs. More people are unemployed, so it means less spending to go into the economy, or more people putting themselves deeper into debt. From there, they spend less, which means that businesses do further layoffs and so on until we reach the bottom of that spiral and then potentially start to get back on track. But what's the Fed going to do? Let me ask you this. If we get to a situation where the economy goes into a pretty big recession and there's high unemployment, what are the actions that the Fed can do to get the economy back on track? Right now, they're fighting inflation, which is killing the economy. Well, what would they have to do to get this economy back on track? I'll let you guys type that in the chat while I read some of these questions here. Merlin, if the Fed raises the funds rate by 50 basis points, what might happen in the markets? If the Fed raises by 50 basis points, the markets are going to take a dump. I think they're going to take a big dump. Why? Because I think it's becoming somewhat evident because of the inflationary data and the retail sales numbers that we just saw that their actions are having an impact. And you keep raising aggressively, you're going to further choke and constrict business expansion, right? The cost of capital for business to grow and buy and merge and do all the things they do to grow, you're making it more and more difficult every time you raise those rates. Therefore, companies go and start doing layoffs. So I think it'll further make the situation much worse. My guess is you'll probably see the Fed halt here. And if it's not at the March meeting, it'll be at the next meeting where they're like, we're done. There you go, Darren. So how do they do it? Oh my God, hope we don't experience another 2008. Well, 2008 was an over-leveraged crisis, right? I don't think we will be as bad as 2008. But, the reality is, and I think everybody would agree with this, there is this ebb and flow to markets. There's always bullish times, and there's always bearish times. It's always just a time of when they are. And it's cycles. It's just patterns. We've been in an unbelievably bullish phase for so long, fueled in part by one of the most aggressive or the most aggressive spending spree by governments and central banks in the history of mankind. We knew that wasn't going to turn out well. It's just a question of when is the turning point, right? When is that going to start to turn and turn into a bear market, which I'd argue that we are in because the markets have just not been able to get their feet underneath them. So I don't think it'll be as bad as 2008, but the market does need to clean house, right? It has to get rid of this systemic infection that the Fed has given us. So Nick and Ivan, yeah, you're right. Daryl is right as well. They'd have to stimulate, right? You have to find ways to get the markets back on track. And how do you do that? You start slashing rates again. You start printing more money. So now you're back to trying to walk that tightrope that the Fed has, ignored for the better part of 13 years, right? When we started doing quantitative QE1, QE2, QE3, Operation Twist, spend, and then all of a sudden the pandemic hit and we put in $15 trillion into the economy. And loans that people don't have to pay back. I saw so much abuse of this, and the honest people barely made it out alive, and the crooked ones made it out super, super rich. Unfortunately, that's just the nature of the beast. However, it's put themselves in a very precarious situation because there's been so much spending, they have to find a way to get it back to normal. And my guess is that it'll probably end with a pretty good surge in unemployment. Hopefully it's not us that are unemployed, or at least put yourself in a financial situation where you have enough runway should you lose your jobs that, hey, I've got enough time. I got 3 to 6 months worth of money in the bank to pay for my mortgages, my living expenses. That's, to me, very, very important to have that backup just in case. Systemic infection, the Fed has given us. Yeah. I try to find creative words, Tom. The difficult part is we're live, So sometimes I feel like I'd love to have a script writer that give me the creative flair for it. But I do think it is a systemic infection. And, ultimately, you need to cleanse your system, get the body back to normal, or get the markets back to normal. And in my estimation, I think that means a much lower market. I think it means a much lower market. We'll probably have a higher dollar. Bond yields are going to have to get back down to a lower rate, but we're not done yet. We can look at the bond markets here. Bring that up real quick for everybody. So we'll look at some of the big factors. We'll run through the markets in just a second, but your dollar index is still trending down. You have, I don't need you to look at the VIX, but people are asking me all about the VIX, like why was it under 20? Well, look, I think the VIX is broken. I don't really use it much anymore. It's just if you want to look at the fear gauge, just look at the market. That's what the VIX is trying to extrapolate. What happens if I don't know. I don't think that there's that's going to happen. If anything, it'll all kind of migrate to online to accommodate demand. But sounds like a great opportunity to impose fear. Well, look, and I don't want to come across Agent Sancho as a fear monger at all. It's just this is what the markets give you. There's always an ebb and flow, right? Always an ebb and flow. So just when the bad times come, you got to figure out how to ride those and make money on them. So here's our 10-year, which actually is good from a growth perspective because I think what you saw today was the belief that the Fed is going to stop raising rates here soon, and that would have an impact on these longer-term maturities. Here's your 10-year right now, just below 3.4%. So the trend right now, at least in the intermediate term, looks like the 10-year is going to continue to drift lower. Although I do have it right at this trend line, which not really a great trend line, but you can see the blue trend line I've got there. Wouldn't surprise me to see that break and start to get a little trend lower. Fine, we need that. The inversion of the yield curve, though, is still the biggest it's been for quite some time. I mean, this is just massive to see such an inversion in the long term versus short term. Now, part of that healing process, if we use the human body as an analogy, this is that systemic infection that the Fed has caused this right here as well by jacking up that short-term yield as really aggressively and long-term people not feeling that optimistic. So you're getting slower increases in the long-term bonds, rapid increases in the short-term, therefore we're staying inverted. Was a little surprising to see such a small move today. I kind of expected a bigger reaction to this in the bond markets, but right now, the trend looks to be to the downside, at least from the inversion perspective, which means, again, short-term going up faster than the long-term. What else did I have in here that I want to bring up? As far as looking at the broad sectors, I don't know why. What's this in here for? Oh, the Nikkei. I was going to add the Nikkei here because someone kept asking about foreign markets, so I'll put this up here. Add it to my watch list. You can bear with me as 1 second as I scroll through tons and tons of different markets. I'll put it up here in a watch list. Okay. So let's start at the bottom, work our way to the top. Obviously, this news, risk-off type of stuff, impacts crypto significantly. It used to be there was an inverse relationship, and I feel like there's a very correlated relationship now between crypto and the overall markets. Even though we had a huge rally for the past couple weeks in Bitcoin, when the risk-off news hit today, where it's like, people getting out of risky assets, like the equity markets, well, I think that's crypto as well. You saw a 3.19% slide in Bitcoin today. Minor correction, which we saw coming. I had a question in my CIL. Someone said, when's the time to buy Bitcoin? I was like, not now. Wait for that pullback. Moving on up the list, we've got the Dow. Now, of course, the Dow was still reeling from the Goldman Sachs news, right? We talked about that yesterday and the ability for that to almost single-handedly slap around the Dow because it is such a heavy component in it. Well, Goldman Sachs still having an impact on it. Dow was down 1.86% today. Russell right behind that at 1.63, closing at 1864. And we mentioned this on the program, talk about this kind of double top or triple top, if you will, almost quadruple top on the Russell and saying, well, there is a decent chance of it turning there. Lo and behold, coordinated perfectly with the retail sales numbers today and had a nice move down to 1.63%. S&P, similar picture, 1.59% slide coming right to that downward trend line we've had drawn for weeks now. More compression. Question is, does it drift down and go to that lower uptrending line, right? And just kind of bouncing back and forth in that range. That would be very logical as well. There's actually a spot right in the middle, which is an RBR for those who are OTA graduates, right around 39.17, which would be a logical target. From current levels, that's about another 28 point drop from current levels. So that would not surprise me at all to see that hit this week. NASDAQ faring a little bit better, only down 1.28%, but still had its spinning top yesterday. Started looking positive this morning and then just gave up the ghost and closed right near the dead lows. Not a great picture there for the NASDAQ. Now, crude oil looked great. Actually, was breaking through some overhead supply here and then all of a sudden started to rip down. So I dumped my energy today. Took a little bit of a loss on my energy and my financials. So I'm back to cash on those ones. I have a couple of XLF because I actually bought the underlier and I'm selling options against that. So I still have a couple hundred shares of that, which is not that big a deal. And finally, gold and silver having a pullback. I'm still bullish. I think you got that line right there at 1876, which I think would probably be a logical spot for a pullback in gold. If that does, I'll probably be a buyer or looking maybe sell some puts on GLD to get down towards that level and ride that trade up to right around that 2,000 mark, which I think is coming. Yeah, well, GS, it's more the pain. I mean, it wasn't up today. It was a green candle. It was down today. Green candle doesn't mean it was up today. It means it was up from where it opened. So it was down 1/4 of a point today. But that pain point, I think, is kind of spreading through the entire sector. If you look at XLF today, right, XLF was down 1.89%, and so that kind of spread to a lot of the financial stocks out there. Goldman Sachs is a little contagion, if you will, kind of even though some of the other companies have reported really good numbers, it just brought down a lot of the financials today. Let's see, Merlin, if the PPI was down, retail sales down, it seems that the Fed won't have to increase rates as much, so why the big drop in the market today? Well, that's what I'm saying. It's because of the retail sales. It's because if retail sales are so bad and declining when they should be surging, right? November, December should have been really good months for retail sales, but those numbers are really bad. That's a sign that consumers are going, either I'm not spending because I need to save, or I'm not spending because I don't have money. Right? I don't. It's funny, the sign of wealth back in, let's call it 10 years ago, that was like having a house and a nice car. The sign of wealth in 2020 was you had all the toilet paper. The sign of wealth in 2021 was you had all the lumber. The sign of wealth in 2023 is you have all the eggs. It's just this weird shift of consumption patterns. And I thought it was it was a random one off the top of my head there. But the point there, Les, is if we, the consumers, which drive the economy, are slowing down our consumption of goods and services, U.S. GDP is going to tank, and unemployment's going to rise, layoffs are going to increase, and more people are going to start to be out of work, which systemically, from this machine, this cycle of economics, is much, much worse. So now the Fed, it was tasked with, hey, let's fight inflation. Now it's tasked with, I have a whole lot of other macroeconomic variables that I need to contend with. So as good as this may seem that the Fed has been so aggressive in raising rates and, hey, inflation's slowing down a little bit, now all of a sudden a whole new slew of problems has arisen. And as I mentioned before on this program over the years and Power Trading Radio, there's always a buzz economic, data point. Right now it's inflation. By the mid to late this year, I'm pretty sure inflation won't be as much of a talk track. The buzzwords for like October, November, December of this year are going to be retail sales, GDP, and unemployment. Those are going to be the main three things that the market's going to be looking at. In 2024, you're still retired. Yes, I know. It's funny because now I'm just doing part-time stuff at OTA. kind of feel like I'm retired. I told myself I was going to retire at 50, and I guess I am. I guess we'll just call it retirement. All right, let me go through and just cover a couple more little quick things. We are 25 after the hour. As far as earnings go, so I saw someone early on say that today was because of earnings. No, the earnings weren't. There were a couple that were bad. So you had PNC Financial, as you guys can see here in the middle. They missed earnings by 11%, and of course, they got caught up in the overall XLF financial slide, down 6%. Discover beat earnings, and they were down 6%. You had Alcoa. Huge beat on earnings, and they were down 4%. So a lot of times you just get caught up in the highlights of the day. Charles Schwab barely missed, right? They missed by 2.7%. and ended up being down about 2.5% on the day. So I wouldn't say that this was necessarily the catalyst for today's downside. There's no major names. Now tomorrow, which we'll get to in just a second, we do have some major names. And more importantly, we start to see some of the tech names roll out tomorrow. We do have a, do I have my graphic? I never use these graphics. I paid to have the guy build them. But we do have a popcorn trade of the day coming out tomorrow, but I will probably wait to the very end of the program to show you that one. Just a little tease there. All right, let's see. How's housing looking? Not good. Not good at all. We actually did, was the data today. There was some housing data that came out recently. I want to say it was today. That was for US. 1 second. So no, the housing data is not looking good. We're starting to see contractions in home prices, right? The HPI data, Case-Shiller Composite 20 Home Price Index, has been tanking sharply. We were over 20% year-over-year growth, which is just ridiculous. Any realtor here will tell you that. Now you have, I think we're at 13 or maybe even less than that. What did Les say? If I knew how great being retired is, I would have retired as soon as I graduated college. If only you have the money to do it back then, right? You got to find ways to keep yourself afloat. Let me real quickly go back to, I'm on calendar here. Just so we can, since that question popped up, I will just go show you really cool pieces here. If you look through Forex Factory, you can go to calendar, and in the top portion, top right-hand corner, there's a little thing that says filter. So I'm going to just say pick only U.S. markets. So let's go USD. I'm going to take only housing data, right? And this is cool because now I can just real quickly look. Actually, tomorrow is the housing data. You have building permits and housing starts tomorrow, as well as existing home sales. But what did previous data tell us? All right, so let's go back. Construction spending, slight increase, not that important. Let's go back to December. And here is the one that really was kind of jaw-dropping, was the rate of change of homes. So here is your Case-Shiller Composite 20 Home Price Index. This basically looks at 20 major U.S. metropolitan areas and says, what's the price of home prices? Are they declining or increasing? Remember, we were over 20% back in May of 2020. That is crazy. We've gone from 20% down to 8.6. Now, the historical numbers, depending on which realtor you talk to, is going to be anywhere between 5 and 9%. So we're back down to average historical growth, but the trend is real concerning. If this continues to slide, as you can see the aggressive sell-off every month, we should get this at the tail end of January, probably in a week or two. If this continues to slide, and that's going to put a lot of pressure on people who are over fixing and flipping houses, right? How many of you guys know people who fix and flip houses? It seems really cool, right? Especially if you watch the E Network or Home Improvement Channel, whatever that one is, you know, where they literally buy a house on a Thursday. By Friday, they've ripped all the walls off and all the interior out. By Saturday, they've put everything back together. By Sunday, they got all brand new furniture. By Monday, they've repainted the entire house, rewired the entire house with all the electrical, and by Wednesday, it sells for double the value, right? This fix or flip bullshit drives me absolutely crazy. If you watch these home improvement shows, anybody here who's involved in that knows that's an absolute lie. That's stuff, you cannot buy a home, strip it of everything, redo all the wiring, put it all back together, and flip it in 7 days. There is no way that could possibly happen, because you need something called permits. And I've experienced county departments before. They are slow, they are generally very stupid, and they think that, oh yeah, I'll get to that tomorrow. There's no way I'm getting through not only all the permits, but all the sign-offs from all the engineers and everything within 7 days. That's no. I'm okay with flipping. Flipping is awesome, but it doesn't happen in a week. You're not going to fully destroy a house and build it right back up in a week with all the permits, all the inspectors signing off on everything. There is no way you'll do that in 7 days on a major teardown of a home. Not going to happen. However, is there good money in fix or flip? That's not entirely the truth, Merlin. It is entirely true. If you're going to take part walls out, rewire, do all electrical stuff, take the exteriors off, take the roof off, and do a full remodel these guys tend to do, you're not doing that in 7 days. That is entirely true. That's correct, Gallo. I understand that not every job needs a permit. But if you're taking any walls out, and the reason I say it is because these shows, they glorify it, and they make it look like it's the easiest thing in the world. And there's great money in flipping. Don't get me wrong. But it's about market timing. And where I was going with this, not to offend you, Gal, I wasn't trying to piss you off. The great thing about flipping is market timing. So if you're in a market that looks like this, let's just and the market looks like that, then flipping is the way to go, right? Gallo, I think you would agree. You want to make sure the home prices are increasing. But if you're flipping homes now and you're seeing home prices drop significantly, bad idea, right? And this is part of the reason you see home prices increase so much is flippers, they'll buy, they'll flip a home, okay, fine, and they'll roll that right into another property, and they keep doing that. The danger there is, and I have a bunch of friends who are flippers, the danger is there'll come that one time where you get caught. And that can take away a lot of gains. It's funny, I have a really close friend who lost almost all of his money buying an apartment. He thought he could just flip it, simple, paint it, clean it, new carpet, real simple stuff that doesn't require any permits. You could be done in 7 days. But when it came to real estate fees and all of a sudden his $600,000 apartment he bought, he was trying to tell you, or he was trying to get out of, he bought it for $650, tried to sell it for $850, ended up actually getting out of it for $350. And it was just because he bought that in like March of 2007 when the market was already starting to go down. I'm like, are you sure you want to do that, man? Anyway, the point I'm getting at here is the housing data is showing that the prices are dropping significantly. And as a flipper, this is not the time to be trying to flip homes, right? Unless you can get an incredible deal. And if you're a good flipper, you're not using MLS. You're not going out there on MLS. There's different ways to get properties before they go to MLS and actually get them at a much discounted price. That's the best way to do flipping. MLS is generally retail stuff out there. So, we could do a show on flipping. I could bring some people on here, and Gallo could be a guest on talking about flipping. But the point is that right now, that segment, which helps drive up the economy, right? Flippers are great. They get in there, they drive prices up. That part's going to be missing. And you're going to see, at some point, I think, Gallo, you'll agree with this, at some point, you're going to get to the point in the housing market where you go, oh, there's a lot of really good bargains out there, but you got to wait for the market to kind of turn. And it feels to me like this Case-Shiller Composite 20 Home Price Index is pointing to even lower prices. If the 30-year fixed rate mortgage continues to rise as it has, then you'll probably see this continue on down, which goes back to the initial question, which was, how's the housing market? It's still strong, I guess, historically, but I guess the cracks are all over the walls right now, if I have to make a housing analogy, that you're just going to get a big correction in the housing market. So there's the Case-Shiller Composite 20 Home Price Index. Do we get to something like this that we saw back in 2007 and 8? I think it's very easy for this to go negative. I do think you could see it go below zero maybe by the end of the year. If rates continue to stay very high, it'll choke out the economy. And if we start to see unemployment surging, then you might see people foreclose on their homes. And I don't think it's going to be anywhere near what you saw back in 2007-8. That was liar loans, bogus loans. That was kind of crazy. But if people start to lose their homes because they were over leveraged, they spent too much money, didn't save, got in over their heads, or now have a really high interest rate mortgage, you could see this get down below that negative line rather quickly. And hopefully it doesn't stay there very long. I think for those of us who are investors, my gut's like, let's go. Tank, get down below that zero line. Let's see contraction in housing prices, because I will buy some property then. I recently sold almost all mine except my primary residence. Actually, I sold all mine except my primary residence and one piece of land on the coast in Northern California. Other than that, I don't own any real estate anymore. And it used to be a major part of my holdings. So I actually will be looking to buy back into real estate from a market timing perspective. All right, so that was the question on housing markets. For having a good economy, do we want higher home prices or a retreat into lower prices? If you want a good performing economy, typically you want higher home prices. And you actually want not necessarily higher home prices. Let me rephrase that. You want increasing home prices, because that's a sign of prosperity. That's a sign the economy is doing good and demand is there. When we have housing prices falling, it's a lack of demand, right? And again, when there's no demand, prices are going to fall. And that's not, depending on the instrument, not necessarily a good thing. Inventory is increasing on the foreclosure. I haven't seen that one, Gallo. Maybe. It might be. I don't know. I don't have that data in front of me. My property went down another 5K. Yeah, I mean, mine's down significantly. But, I was on the fence about selling. But, if you're a market timer with your house, real estate can be a great thing. In the long haul, though, it's much harder for us to sell a house than it is to sell 1,000 shares of Apple. So I kind of resigned to the fact that I plan on staying here for a little while. I'll ride it out this sell-off, and maybe I'll sell it in the next bull market run. Fast equity increases in real estate. Let's see. Curious, how does this affect the corporations that were snapping up all the houses yeah, and that's a great question, Lisa. Ultimately, what's going to happen? I mean, if you take the corporation, look at it, it's just a bigger human being, right? A corporation is made up of hundreds of people, but they're going to try to do the same thing that we are as individuals. And if I bought a piece of property that I'm heavily underwater on, I guess I have to ask, what's the objective of me as purchasing those properties? So if you're a corporation that's been buying a lot of homes and you're renting those out, I don't think you have a worry, because people are still going to rent, right? When you have a big market correction like this, it might push people out of physical homes of ownership, but they got to put a roof over their head somehow. So renting markets will probably still do rather well. Quentin says, what about commercial real estate? I'm not a realtor. I just love doing real estate, investing in real estate. But from what I'm reading, commercial real estate is getting slaughtered. I think that statistic I read says that I think 37% of the commercial buildings in San Francisco are vacant. Like, whoa. And it's been like every quarter for a couple years now of just vacancies rampant in San Francisco. Now, that's just because I was reading some articles on it, but I don't know. I'm sure many of you know way more than me on that. Ron was here. I know Ron Fields is one of the realtors, is a pretty big realtor. It seems like commercial real estate is hurting pretty bad. I mean, look at how quickly these markets have shifted from 2020 to where we are today. I'm willing to bet that, I mean, we got about 90 people in here. I'm willing to bet that at least 1/3 of you, maybe even more than that, now work from home pretty much full time. Don't even go back to the office. Maybe go back once in a while for a meeting, but it's all remote working now. So if I'm an employer and I used to have, let's say, 500 employees, but now I've got 100 come to work, I'm going to downsize my office or just tell everybody, hey, work from home. I don't need to have all that extra floor space. So I think that commercial real estate is going to hurt for a while. I don't see any quick solution on that until maybe we get back to the point where we say, as an employer, I would rather you be in the office. You know? I know how I can be sometimes. I'll be doing the work that I'm supposed to do, and all of a sudden I'm like, ooh, wow, here's a YouTube video on how to play the bass for Stairway to Heaven. Well, let me just play that one for a half hour, right? Yes, me and my husband both, yeah. You know, it's funny because I work from home, but I was trying to go back to the office 4 days a week. I teach on Thursday morning, so I do that from home, but I was trying to go to the office 4 days a week. Now, I barely go back there. I go back to the office just to say hi to a couple people and go out to lunch with Larry on Friday. That's kind of my routine. If you're watching, Larry, good to see you, my friend. I'll see you Friday. In Long Island, New York, I get 3 to 4 emails a week offering commercial. Yeah, I would not. It's funny because years ago, I was actually looking at getting into commercial real estate, like to buy some property as investments, but I'm holding off right now. And again, it ebbs and flows, right? Right now, commercial real estate is horrible. At some point, it will get to that an area of demand or an area where people go, okay, now it's a good buy, and I'll start acquiring some of these properties, right? It's just, what's the cure for a high price? A high price. Love that line. You're concerned? We're getting closer to the Great Reset along with the CBDCs. Well, I'm not going to worry about CBDCs yet. I mean, it's going to come. Don't fear it. Embrace it. Understand what they are, and maybe we can do a better show on CBDCs in the near future. Let's see. What else do I got? Acquire more real estate for investments, for rental as assets. Why not? Yes. So that's where I'd be looking, Rob, is the math formula for everybody here, if you are looking at real estate, is if I'm going to buy, let's say, $1 million, whether it's commercial or residential, I got to look and see, do I have the income streams coming in? So let's say it's, I buy $1 million property and I have to pay $4,000 a month in overhead. Right, that's my cost. Well, let's say $5,000, and that's all the maintenance for the building of the house, whatever. That's all in. If I'm not getting $5,000 or more per month out of that, then it doesn't make sense. Yes, I could get some property value appreciation, but I need to make sure that no matter what, whether I'm residential, commercial, doesn't matter, that whatever I'm paying, property taxes, insurance, all my pity and everything, that whatever that number is, I need to be making at least $1 more than that. I have to be making, otherwise it's just a losing proposition, and now you're hoping that you get property value appreciation to offset the losses that you have on your income. But done right, rental property is a great way to go. If you look at most of the millionaires, or I'd say millionaires, but they're very wealthy people, they don't have one income stream. They have multiple. So they might have a job they do. They might have money coming in from investments. They might have money coming in from real estate. They might have royalties from music or songs or license agreements or something like that. But generally, you want to have more and more income streams. And setting up real estate to be a positive stream there is a great one. I'm very fortunate that my father helped me with that one years ago. We had some properties in Texas and got a property management. And basically every month, it wasn't a huge check. It was actually rather small. But every month, above everything, including all the property management, I would receive money in my account as long as those apartments are filled. So yes, and tax, you do get tax write-offs. There's a whole bunch of benefits there to real estate. I would like to do more shows on real estate, but maybe down the road. All right, let me wrap things up here because I have way too much I have to get taken care of personally. Let's go to your your earnings calendar for tomorrow. And as I mentioned, we have a popcorn trade of the day. I need a sound. Maybe I'll go make some popcorn later on and just record it with a microphone and throw that as an overlap here. But popcorn trade of the day tomorrow is going to be Netflix. Now, Netflix, this is the Jim Cramer special where he was telling you up, and I forgot exactly what the price was. Let's go NFLX. Here's Netflix, which has been phenomenal since July. Really just been a great run, over 100% gain. But here's Jim Cramer saying buy it when it was up at 600. So thank you, Jim Cramer. You're still a net loser on that one. But Netflix, being a $326 stock, is going to have a wild swing tomorrow. Check that one out. It will be aftermarket close, as you can see here, the AMC following that. That is aftermarket close, so grab yourself a bowl of, for those who don't know, what's a popcorn trade of the day? That's where you grab yourself a bowl of popcorn. Could be microwave, could be on the stove, could be Jiffy Pop if you need. Put it in a bowl and sit there and just watch as it happens. Change your chart to a 1 minute intraday, extended hours trading so you can see it happen. Don't trade it. They're way too nuts. You get like 10% swings in a matter of 60 seconds on some of these things when it's a popcorn trade of the day. So that's your popcorn trade of the day is Netflix, but also big names, or one other major name, Procter & Gamble. So those of you looking at consumer staples, that's one of the biggies out there, which consumer staples have probably done rather well, and I assume they're going to continue to do well just because I'm not cutting back on my toothpaste or shampoos and things like that. Key Corp, Comerica, Fastenal, and Fifth Third Bancorp. No idea why they call them Fifth Third. Just such a weird name. But that's all happening tomorrow. And then here's your economic calendar. Now, we do have some unemployment data coming out tomorrow, which is normal. It comes out every Thursday. That's going to be your unemployment claims, which they're expected to see an increase there. Philadelphia Manufacturing Index. Remember, we had the New York Empire State Manufacturing Index, which was way worse than expected. We'll see what happens here with the Philly Fed tomorrow at 5:30 Pacific. That's 1 hour before markets open. If you're trading the U.S., you also have building permits and housing starts. They're going to go in different ways. Housing starts are expected to decline, and building permits, which makes sense during a recession, people do remodels in their houses and just kind of improve the home. Those are expected to increase, but housing starts going down. You also have crude oil inventories, natural gas storage, and FOMC member Brainerd speaking tomorrow. If you're trading the euro, you do have German PPI numbers and retail sales numbers coming out for the UK. All right, let's see. I'm looking at a 2,500 square foot condo on El Poblado, Medellin. 4 bedrooms, 4 bath. Oh, man. Yeah. And this is, Naum, I'd love to live in different countries. And Medellin, maybe not so much. Maybe I know it's beautiful, but I feel like it's still a rough area. But there's a lot of beautiful parts of the world. Mine place I would go would probably be Thailand because you get so much more for your buck. I mean, you get an unbelievable. But the issue is you can't own as an American as a foreigner. So maybe get some Thai citizenship, but I don't want to denounce my renounce my U.S. citizenship. Still proud to be an American, even though I think it's totally screwed up right now. Let's see. Income advice: get elected to Congress, get lifetime income, and you will become an expert stock and options trader. And even more than that, Tom, and you get lifetime benefits. I think you just need to serve one term. One term. Oh, come on, man. I guess getting to president, when you get $250,000 a year for the rest of your life, it's like, wait a minute, you're done. You're not doing anything anymore. Why should I have to pay you? Anyway, I'm there. Thailand, great food. Oh yeah, love it. It's great food. It's beautiful. The people are so nice and so friendly. They're like very calm. It's a tough language to learn, but yeah, I could see Thailand being my final resting spot. Get over there. Okay, and get some suits. I haven't had a custom suit made in quite some time. I'm getting a little pudgy around the waist as you get older. I think we all know that one. So yeah, maybe I'll do a little exercise and go get some new suits made here my next trip. I've been wanting to take one and just some weird flight anxiety thing hit me. Anyway, I'm going to wrap things up there. Tomorrow, I should have Scott McCormick on the program. I'll make sure I talk to him. I'm going to get him a reminder that he's going to be on the program for tomorrow. We'll talk about the Beck report, which is bonds, equities, currencies, and commodities. See where he stands, any major changes he's seeing on those fronts. If you guys have questions for Scott or myself, a couple things you can do. Number one, put them down below the YouTube videos. That's the easiest way to get your questions brought into the show. Or you just pick any YouTube video. It doesn't matter. Just put your comments down below the chat. Oh, yeah. I have to say I have fallen off the wagon. I have not been doing what I'm supposed to be doing. I've been writing on my book a little bit, so I'll put this up here because I'm guilty this year. I have not been doing my 50 burpees. I've been going to the gym a couple days a week and doing some push-ups, but I was doing the burpees and then my back started to hurt me and I stopped. I'm failing, Lisa. I'm failing. But I am writing on my book, which is good. I've actually been going back and forth between a couple, but believable direction. I hope you're still doing your push-ups and your guitar. Lisa, are you doing your burpees? You have 5 a day. So, I mean, that's good. Got to start. Let's see. California's doing 44 push-ups a day. Strange number. I'm surprised why you did 44. Joe, run 5K 3 times a week. Minimize trading mistakes. I got Chris doing 100 push-ups a day. That's a tough one, but the results are dramatic when you do that. Mike C, 50 push-ups a day. Tom Messina, 5 push-ups a day. And Tom B, exercise on your shoulders and knees and stick to your trading plan. Oh, awesome, Lisa. That's great. Good for you. Keep that up. I'm sure the first couple days were brutal, but after a while it gets a little bit easier. I will get back into it. I've actually just had a lot of other personal things going on that have distracted my attention and made it very challenging to do these things. So I'll get back on track here. My February challenge, I will stick to it, but maybe you guys are going to entice me to go do some burpees right now. So that's going to do it for today. Scott McCormick on tomorrow, talking about bonds, equities, currencies, commodities. If you have a question, the sooner you send them in, the more likely I'll get it on the show. Sometimes, as you see here, you guys are doing a whole lot of chat, and I don't get to all those questions. I apologize, but send them on in at TraderMerlin@gmail.com. That said, have a fantastic remainder of your day. If you like the show and you're new, hit the subscribe button, hit the thumbs up, and I will see you guys tomorrow. Take care.